Okay, we're starting off the third part of, this is Accounting 113. We're starting off with part 3 of the course, and it's on taxes. And I'll tell you, this is a hard section. It's hard because Congress has passed a lot of tax laws. And again, by the way, you're just getting this much. You're getting a tiny piece. You're getting a tiny piece of tax laws. But we're going to be working at beginning on sales and payroll taxes. And everything you need should be on Moodle. For instance, the first thing you'll need is the schedule. And in the schedule, I'll click on that just to bring it up and show you. But again, we're going to see if I can maximize this, just to make it bigger. But part 3 of the course, I want you to read the chapter. I do have a chapter posted on there. I want you to work the following exercises down here. And I've already got most of the answers posted. I just posted them today. But anyway, like I said, read and work the exercises, and I'll do the exercises, and post them as a lecture. The other thing I wanted to say, by the way, let me scroll down and show you. There's the exercise I want you to work. I'll probably have some more than that, but that's to start with. Then, here's your reading. You can see I've got the chapter 13. There's not that many pages in here. You can actually see the top. It'll say again, it'll tell you what pages to read. The name of the file tells you. There's only about 9 pages I want you to read in there, but they're hard pages. You better read them 3 or 4 times. They're very hard pages. And let me see, what else are we going to do here? Here's the lecture. Now, these lecture notes, I'm going to talk about every single one of them. There's 3 pages of lecture notes. But this is very hard, very detailed, and it's just simply the way it is. If you go into any business at all, you're going to have to deal with, again, payroll taxes and sales taxes. It's a base of every business, unless it's a not-for-profit. If it's a not-for-profit, don't worry about it, or a charity. But everybody else has sales taxes and also payroll taxes. Anyway, you better read. There's 3 pages to my lecture, and it's very, very good. I just wrote it the other day. It's brand new. It's not dated or from 20 years ago. But in my problem solutions, when I solve the problems, I'll talk about everything in here. But there's no better place. You'll not understand that as I do the problems. You will not understand it unless you go read this several times. It might take you 5 or 10 times to look through these 3 pages to put this in your mind. Tax laws are detailed. You'll find out. So go read those. And again, when I work the problems, I'm working the problems on the basis that you have read this. Otherwise, when I work those problems, you're going to be thinking, what's he doing and how's he doing it? Why is he doing that? So go back and read the lecture and again, read those 9 pages. I'm going to take a break just for a second. Again, this is 113 accounting, entrepreneur accounting, and we're starting, actually the topic is sales tax and payroll tax. We're going to be working BE5 and BE6. They're on page 692. They're in chapter 13. Now, chapter 13 has no meaning to you because I just went out and found this in a book. But it is, that chapter is posted on Moodle, so you can go look at that chapter. I've only assigned 9 pages out of that chapter to read, but they are 9 hard pages, so you better read them. Read them 3 times, so you got 3 times, so that's 27 pages. Anyway, the first one we're going to work, BE5, is on sales tax. And let's just take a look here. I pulled this. This is the chapter 13, and this is being pulled from Moodle. So you can go to Moodle and get this. Everything I'm doing here is being pulled from Moodle, and the answers are already on Moodle. Everything I do is from Moodle. So on BE 13.5 basically says, all right, again, we've got a company, Dillon's Corporation. By the way, just a little background, sales taxes. Again, every retailer, again, collects sales taxes. Individuals pay sales tax. If you sell a car, you're going to the buyer will pay sales tax. If you sell your boat, the buyer will say sales tax. If you sell a motorcycle, the buyer will. Again, all sales transactions are subject to the state of Illinois sales tax. The sales taxes actually are split. Some of it will go to the state of Illinois, but some of it will stay in the county, and some of it will stay in the town. In other words, here in the town of Normal, I believe the sales tax rate is about 8.75%. And the 8.75% is shared between the state and the county and even the town of Bloomington. By the way, if you go from Bloomington, or if you go from Normal to Bloomington, that rate may be different, because Bloomington can pass a different sales tax. And if you go from Bloomington to Clinton, Illinois, or to Eureka, Illinois, they can have different sales tax rates, because each town and county are allowed to pass what tax they want to have for sales tax. Anyway, whenever you buy something as an individual, you have to pay sales tax, but that person who gets it has to collect it and then give it to the state of Illinois and give it to the county and give it to the town of Normal. This is a good example of that. This says Dillon's Corporation had credit sales of $30,000 and they're subject to a 6% sales tax. The corporation also made cash sales which were $20,670, including 6% sales tax. That's really saying two different things. This is $30,000 which are subject to 6% sales tax. This is $20,670 including, the word including, this is subject to. What they're really saying is that number, $20,670, already has the sales tax in it. That's the total amount. This $30,000, when they sold this to somebody, they didn't put the sales tax on it yet. So these are different computations. Anyway, they say A, prepare the entry to record that. So let's go ahead and do that. The entry to record that, A, would be, again, this is a credit sale of $30,000. So we're going to debit accounts receivable. Remember, it's a credit sale. We've done that before, accounts receivable. But for how much? Well, 30,000 times 1.06. You see, the sale was 30,000, but it said they're subject to 6%. Did I do that? Yeah. So 6 times 3 is $1,800. So this is going to be an account receivable for $31,800. That includes $30,000 for the merchandise and $1,800 in taxes. They can credit now. Do you remember what we credit? Sales. We credit sales because they really did, in fact, credit. They made a sale of $30,000. But what are we going to do? We know that debits have to equal credits. What are we going to do with this $3,000 or this $1,800 we've got? We owe it. It's a liability. We owe that money to the state of Illinois. We owe it to McLean County, and we owe it to the town of Normal. By the way, you don't have to write 3 checks. Usually you write the check out, I think it's called to the McLean County, McLean County Circuit Clerk. I think that's who it is. You write out the check to the McLean County Circuit Clerk, and they'll collect all the money and then give it to the various constituencies. But we're going to credit what? A payable. We owe that money. We're going to say sales, taxes, payable. We owe that money to who? The McLean County Circuit Clerk. So again, there's the journal entry. You see, again, this is what you have to do. Now, later on, you're going to debit this and credit cash. You're going to send that money to them. But right now, this sets up and says, all right, we pretend this was a cash sale. If this was a cash sale, you just debited cash, you credit sales, and then you credit sales tax, you've got to give that money. Later on, you'll have to just give that money, send it off in a check. All right, now let's do Part B. Part B is a little different. Part B again says there was a sale of $20,670, but it already had. Whoever rang it up, that's the number including the 6%. So again, this one is a cash sale, by the way. It's a cash sale. So let's go over here in Part B and debit cash. And that's going to be for $20,670. Is that what they said? $20,000. Now remember, this really has in it, this has both the goods that were sold, it's in there, the goods, and it has the tax in there too. And the tax was 1.06. Now we're going to credit sales, and we're going to credit sales taxes payable, just like we did before. But we have to go back and find out In this one, we added the tax. Well, if we found the tax by taking 30,000 times 1.06, guess how we're going to take the tax back out of this? We need to take the tax back out. We don't have the tax. So if you multiply it by 1.06 to go backwards, divide it by 1.06. So take $20,670, divide it by 1.06, and you'll get, I think, 19,500. I did this problem earlier. So our sales, that gets you back to the sales price, 19,500. That's what, again, we really sold. What we're really seeing is we sold 19,500, and then what was the extra? That's going to be $1,170, the difference between the two. So the sales tax payable must be $1,170. You see, that's the difference. Here's the goods. We pulled out, by dividing by 1.06, this is the amount that we sold. This is the cost of the goods that we sold, 19,500. We collected 20,670. Well, that's $1,170. That must be the sales tax. So in the first case, the sales taxes hadn't been added. In the second case, they had, so we had to back them out using division. Anyway, you see both times, in this case, they got the cash. They're going to have to give up, though, this cash. They'll have to write a check to the McLean County Circuit Clerk for $1,170 and send that to them. That's the nature of sales tax, and it occurs on every transaction that's, again, a transaction for profit. You know, again, every place in town, but it would not apply to churches or colleges or government agencies or any kind of charity, you know, the Red Cross. Okay, so this is exercise B5 done. Now let's move on to, again, B6. B6 is a different topic. It's payroll tax. Payroll taxes are harder, I assure you. All right, let's just draw a line right here and say from here on down, this is going to be BE. By the way, BE stands for brief exercise. Brief exercise. These are actually supposed to be easy. Brief exercise 6, and that's what we're starting on right now. BE6. This only has one part to it, but this is dealing with another payable. You see, that's what this chapter is about. It's about, chapter 13 is about things that you have to pay, payables that you owe, current liabilities. Payables are current liabilities. Now, BE6 is going to deal with payroll taxes. Do you guys remember when you get your paycheck, if you make $1,000, you never get a paycheck for $1,000. You might get a check for $700. What do? They withhold your income taxes for the state. They withhold your income taxes for the federal government. They withhold something that they call Social Security tax, which has Social Security for Medicare, and it has Social Security for, again, old age, survivor, and disability insurance. That's basically your retirement. And that's called, by the way, I always call those two taxes together the FICA tax, but actually that is wrong. But I'm still going to do it, I don't care. Anyway, so again, they're going to withhold all those. By the way, you as an employee can tell them to withhold some money, even more than that, for charities and have them remit to a charity. You can have a pension. If you have a pension, you can have them fund that. If you have health insurance, you can have them withhold the money for that to pay for health insurance. You can have them, there's other things that you can have them withhold money for. But anyway, that's what we're dealing with here is when they write, again, these are all monies that are owed. You see, you owe the federal government, you owe the state government, you owe that charity because you said you'd give to it. You owe the, let's say you're paying union dues, you owe for the union dues. You owe for your health insurance. All those things are liabilities, and that's what we're going to pick up when any employer has to do a journal entry for payroll, when they pay payroll, wages. So let's go back and take a look at exercise B13.6. Lexington Corporation's weekly payroll is $24,000, and they're going to withhold FICA taxes. Remember what that is? FICA taxes are Federal Insurance Contributions Act. And I'm going to say that that has in it both Medicare and Social Security. What that means is when you get old and when you're 65, some of that money is set aside for health insurance, Medicare. Some of the money is set aside for your retirement, just getting a little bit of money to pay your rent or whatever you have, or that's again for food, I don't know. But $24,000 is the total payroll for all the employees. they're going to withhold some FICA taxes. I think my camera might have just went off. I want to check. Nope, still got a few minutes left. They're going to withhold $1,836 for the Social Security taxes. Federal taxes, when they say federal taxes withheld, that means federal income taxes. You know, in this country, that's the way that the United States government funds the military. They fund, obviously, Washington, D.C., all the buildings in Washington, D.C. They fund Social Security with some of that. Did I say they fund also all our, I did say the military, didn't I? Anyway, any federal government programs, all that's funded with that money. Anyway, they're going to withhold for federal income taxes $2,990. The state of Illinois is going to withhold $920 for whatever its state programs. Those are roads and bridges, by the way. I do think that the federal does do the interstates. They're responsible for the interstates. And insurance premiums, not positive on that, but I think. And insurance premiums withheld at $250. Those are for your health insurance product. Prepare the journal entry to record Lexington's payroll. Well, how about we go back and say that's an expense. Wages, this is an expense. The money is gone. We're going to pay these people, so we're going to do wages expense. And it's going to be $24,000. Wages expense, $24,000. But guess what? You're not going to credit cash for $24,000 because you're never going to get that. Because remember, they're going to withhold all these taxes and give them to these various government agencies. So let's go back. They've got FICA tax, that's Social Security. You want to call it that? Let's just call it FICA payable. F-I-C-A, FICA payable. Again, we're going to have to, what we're really saying is we're going to take that money out of here, and later on we're going to send it to the federal government for again, your retirement and Medicare. And how much did they say that was? $1,836. Then they said they withheld from your pay, from everybody's pay. Let's say they're running a payroll with 30 or 40 people in there. Then they're going to withhold federal income taxes of $2,990. So let's just put federal income tax payable. And what did we say that was? $2,990. $2,990. Then they're going to have state taxes withheld. That's state income tax. So we'll say state income tax payable. And that was $920. And they had insurance, probably health insurance premiums. That could be some other insurance. That could be life insurance, or I don't know, but it's probably health insurance. $250. So let's just put insurance payable. They're going to send that money off to an insurance company. $250, more than likely for you. It's probably a copay for your health insurance. Prepare the journal entry to record Lexington's payroll. Now again, I want to tell you what's going on here. Let's pretend you're inside this. You're part of this wages payable. This is your money. Let's say it's you and about 20 other employees. They're not going to give you all this money. They're going to withhold. This is your money, your pay. They're going to withhold all these. They're going to send this money, after they keep it from you, they're going to send it off to the federal government. Here they're going to send this to the federal government. They're going to send this to the state of Illinois. And they'll send this to Blue Cross Blue Shield. I don't know. It could be Blue Cross Blue Shield. But anyway, let's go ahead and just all right, we ran out of video there. I don't remember exactly where, but I know I'm pretty close. Let me go back and recap. Let me pretend I didn't write this, because I don't think you saw me. I think my video went off before that. All right, we know that this is the money that you make. Let's say again, I'm here too. This is payroll, and there's about 20 or 30 of us. And this is our money. The employer, let's say it's Illinois Wesleyan University, they're not going to give you this. They're going to withhold all these. They're going to take some of your paycheck and send it off to the federal government for, again, your Social Security. Some of it's going to be sent to the federal government to fund, again, just the federal government's income tax for the military and again, bridges and roads, the interstate system. This will be for the state income tax. This will be for roads and bridges and again, government buildings in what's the capital here? Springfield. And then insurance payable, this will go to Blue Cross Blue Shield. But we have one more part of this. You do get your check. You see, we got to have credit cash. This is going to be where they send each of us our paychecks. And actually, to get this number, you just take the $24,000 that we all made, subtract all the withholding, and that will be, let me see, $18,004. And again, how you got that was you took $24,000 minus this, minus $29,900, minus $920, minus $250. There's your gross pay, there's your net. Now, by the way, there's much more detail to this, you might have guessed. This is at a macro scale. This is for the whole payroll. You realize that there may be 30 employees. Each little piece of this has to be divided by 30 employees, what they get paid individually. And each of you, they have to keep track of the FICA tax, the federal and the state income tax, the insurance. So do you see that you're just getting an introduction to the detail necessary to, again, track payroll? And payroll, we haven't even really gotten to the rules yet. Payroll taxes are going to be much harder than this. So that is BE5, we're done with that. That's BE6, we're done with that. And then we're going to go on to the next one I've assigned in the syllabus is, I believe, exercise 13.2. And let me press pause and we'll pick up there in a second. Accounting 113. We are still working on liabilities. We're going to work exercise 13.2. We're again on part 3 of the course. Part 3 of the course is going to be sales taxes, it's going to be payroll taxes, and it's going to be some other things that we have to pay. Notes payable and interest payable. Again, these create liabilities. These, again, notes payable are all the things we're talking about are liabilities. All the, again, all the problem we just did. Remember all the credits we did? FICA payable. The other one was union dues payable. Oh, that really wasn't their problem. But then we had state income tax, federal income tax, insurance premiums that we pull out. All those are payables, and we're going on with that theory. Exercise 13.2 is on notes payable and interest payable. And by the way, the two are inherently related. If you borrow money, you pay interest, you see? In fact, they really are inherently related. One does not get created without the other. You have to have a note or some kind of debt to generate interest. Anyway, we're on page 693, and again, we're in that chapter 13. That doesn't mean anything, but that is posted. That is posted on Moodle. All this, again, is posted on Moodle, including the answers. In this problem, we have the 2017 is the year we're in, and the name of the company is Sean Austin. I believe he was one of the hobbits, wasn't he? Yeah, I think so. I don't know. I'm not positive, but it seems like that name does ring a bell. And they said they have a transaction on September 1st, October 1st, and October 1st. And the first requirement is prepare the journal entries for the transactions above. Well, I guarantee you these transactions are going to be dealing with interest and notes. All right, in the first transaction, it says we bought some inventory from Encino. Remember, we're Sean Astin Corporation. We bought inventory. Let's again say Sean Astin sells, they sell movies. Sean Astin sells movies, and they bought a whole bunch of DVDs. I know that's a pretty dated example, but run with me on this. Purchased inventory from Encino Company on account, $50,000 worth of videos. That's a lot. Let's again say they're going to sell them at Walmart for really cheap. Austin records purchases gross and uses a periodic inventory system. Well, we've actually done this before. We did this just for the last test, but we're going to go over here and say let's debit. Let's debit inventory. Remember, we're buying inventory. And how much are we buying? We are buying $50,000 worth of inventory. So let's just go ahead. We've done that in the exact last chapter. And then we credit because we bought it on credit, right? It says we bought it on account for $50,000. So remember, we're going to credit account payable. And that's going to be to Encino, isn't it? E-N-C-I-N-O, for $50,000. Now this is an account payable. We're going to find out that accounts payable in general don't bear interest. Some do, that's not entirely true. Some accounts payable, if you get past due on an account payable, will charge you interest. But the theory behind an account payable is you open up an account, you charge on it, but you're supposed to pay within 30 days, and if you do pay within 30 days, you're not charged interest. So that's exactly what this is. In other words, this is the account Sean Austin, S-E-A-N-A-S-T-I-N, Aston. I think his name is not pronounced Austin, it's Aston. But anyway, Sean Aston, again, he owes this money, but there's no interest going to accrue on this because, again, it's just an account payable. He'll pay it in 30 days. So that's the September 1st entry there. That's just a review. But then look what happens on October 1st, September, October, that has been 30 days, right? In 30 days, it says we issued a $50,000 12-month 8%. Can't see that very good. That's 8%. 12-month 8% note to Encino in payment of the account. They really didn't pay the account. That's a fib. So remember who we are. We're Sean Austin, or Aston, and again, we just said, well, you know what, we'll pay you. We haven't paid him yet. We said, how about this? We'll pay you with a note. This is not payment, but we're going to substitute it. So you say, all right, instead of an account payable, you're saying you want to give me a note payable? And I say, yeah, I'll give you a note payable. Pretend I'm Sean. I'll give you a note payable that'll bear interest. Would you be happy with that? I said, well, okay, I'll take it. The truth is, it's really not much better than the account payable, but at least it bears interest. So what are we going to do? We're going to get rid of the account payable. Because again, he's saying, I'm going to pay you off. I'm going to debit accounts payable to get rid of it to Encino. And you know what I'm going to credit? Again, I'm going to get rid of that. That's $50,000. That note is now gone. Excuse me, that account payable. And now I'm going to credit note payable. $50,000. Now, if you're asking yourself, what did we accomplish here? Let's look. This account payable and this account payable cancels each other out. So now we have bought inventory and we have a note payable. You see again the whole theory here is that Sean didn't pay. Let's again pretend I'm Sean. I'm Sean and I didn't pay. So they came back and Encino said, hey, since you haven't paid in 30 days, give us a note and start bearing interest. So I said, all right, I'll go ahead, and I don't agree with this statement. It said, issued a $50,000 note to Encino in payment of the account. They didn't pay it. They really just replaced what? They replaced, this is what they did. They replaced an account payable, they got rid of it, and now we credit note payable, but that one bears interest, and it bears interest at 8%. Then, a third transaction is on October 1st, the same day, they went to the bank and borrowed $50,000 by signing a 12-month, zero interest bearing $54,000 note. I guarantee you there is no such thing as zero interest. But you might say, well then why did they say that? Well, they're not telling you a rate, but do you see where the interest is? They're going to loan you $50,000 and they're going to make you pay back $54,000. They don't tell you an interest rate, they say it's zero, but it's not zero because you're going to pay back more than you borrow. So there's interest in there, and probably, let's take 8 times 5 is 4. So it's an 8% interest rate, you see? 8%, 8 times 5 is the $4,000. So it's an 8% interest rate. They don't tell you, but. So on October 1st, let's do this. They borrow the money. So we're going to debit cash. Debit cash. And we're going to get $50,000. Now we're going to credit, again, a note payable. For $54,000. Or no, is it 54? That's right. All right, well that journal entry doesn't work. I know that's probably what you're saying. You're saying, well, I see this. Let me make sure I got my numbers right. They're going to borrow 50 and they have to pay back 54. So you say, all right, I got the 50. I showed you that I owe 54 back. I know that many of you are saying, I think you need a $4,000 debit to make this work. And they have an account for that. It's called discount. Discount on note payable. And you might say, what in the world is that? I've never heard of that. Well, a discount on a note payable is exactly kind of what it says. Take the 54 minus the discount. What do you get? 54 minus 4 is the 50. A discount is a contra. It's a contra account. Again, the note payable, this will always attach to it and subtract from it. This tells you that right now, if I was Sean Aston, I said, I want to pay this off today. Again, today means the very day I took it out. I'm going to pay this note off. Well, this isn't, by the way, the same note. This is, Sean's note is up here. Down here, this is, again, a different note. Let's see, go to the bank. Oh, this is Sean, though, that takes this out. This is the money that Sean owes Encino this. He owes a bank this. Anyway, Sean goes to the bank the very same day, October 1st, but let's say it goes back a few hours. In a few hours, he returns to the bank and says, I want to pay it off. He will not pay off 54. He'll pay off 50. Because the 54 minus the 4 is equal to the 50. You always take these two and subtract them to get the value of the note. Anyway, we're going to find out that, again, by the time this note runs its course, he's going to pay $54,000. By the way, this note that he signed over here is at 8%. 8 times 5 is $4,000. The author did this, and I did this, because I'm trying to show you that these notes, even though they look a little different, they're the same thing. 8 times 5 is $4,000. And again, this is going to have $4,000 of interest. This is called a discounted note. This is called just a note that bears interest. But they're really the same thing. They're just terminologies a little different. All right, that was, again, A. We are done with A. Now it says prepare the adjusting entries at December 31st. All righty, at December 31st, let's draw a big line here. And that was exercise 13.2, part A. Let's go down here and do part B. And now we're at December 31st. What's happened at December 31st? Well, we've got two notes here, and both of them have had what? You've had October. October's 1 month. November is another month. And December is another month. That's 3 months. 3 months have gone by. And guess what happens in 3 months when you have a note? You have to bear interest. You have to pay interest. Now this says that it says the interest, it's 8% note in payment of the account. It actually doesn't tell us when they're going to pay it, but I guess in a year. It says a 12-month note. Well, only 3 months have gone by, and I know some of you are saying, well, if only 3 months have gone by, we don't have to pay the interest yet. You're absolutely right. You don't have to pay that interest yet, but you owe it. Nonetheless, you owe the interest. In other words, 3 months have gone by, and you owe for 3 months of interest, and it just so happens to be December 31st, which is the end of the year. So you have to do that for your financial statements. You have to put down the interest you owe. And we're going to take principal times interest times time to get the interest. The principal on this note is $50,000. The interest rate is 8%. Let's do that in a decimal form, not percentage. And the time, if you take 8 times 5, you'll get $4,000, but only 3 months has gone by. Do you see this is a yearly interest rate? If this is a yearly interest rate, what portion of that 5 times 8 will give you a year's interest? I don't want a year's interest. I only want 3/12 of a year's interest. So that's going to give me $1,000, isn't it? Yes. So over a 3-month period, I owe $1,000. Let me give you a hypothetical. I'm Sean Aston, and I walk into the bank 3 months later on December 31st. I say, I want to pay this off. The bank will say, I want $50,000 plus 1. $51,000. Now, I know some of you are saying, but you said it was going to be 54. No, it's not. If you don't run the full 12 months, you don't have to pay the full $54,000. If you just run 3 months, you'll have to pay 3/12. 3/12 of that. And that's what you're going to pay. 3/12 of the 4,000 is 1,000. So we have to make a journal entry, and we're going to debit interest, expense for $1,000, and we're going to credit because we're not going to pay for, again, we're doing this is called an accrual. You guys remember, It has happened, but it hasn't, no cash has moved. Accrual. It occurred, no cash has moved. That's what accrual means. This is going to be interest payable. $1,000. Now, the journal entry is the same, at least for you guys. We're not going to get into this discount business anymore. But the journal entry is the same for both notes. Both notes are buried in interest, so we're just going to do this. December 31st, debit interest expense, credit interest payable for $1,000. And you can do this journal entry for both notes. Actually, that isn't the right way. If you ever take a higher level accounting course, we can get into discounts and how to amortize a discount. But you don't have to do that. Just know, again, that the same thing, if I give you a note, it's going to be like this on the test. I'll tell you right now, it's not going to be like this anyway. It'll be like this, and I'll say, all right, you need to show me what interest has gone by, what we need to be charged for, and this is the journal entry. Debit interest expense, credit interest payable for $1,000. That's accruing interest. And you see, again, the pattern here is we're dealing with interest payable and note payable. And that was part B. Now we're going to do part C of the problem. And let me check my camera to see how much time I've got left before it shuts down. Okay. Should have plenty of time. We're on part C. We already did part A. This was part A, this whole thing. Part B was just this journal entry, but you can do it on both notes. You can apply this journal entry to both. You really should do it 2 times. This journal entry should be done twice for each note. And then C, it says compute the net liability. Well, I wish they would use the net, in this. I wish they would just say compute the total liability to be reported on December 31st for the interest-bearing note and the zero interest-bearing note. Well, it's going to be the same. It's because they're the same. Again, how much do you owe? You owe a note payable of $50 and you owe interest payable of $1. So the answer is $50,000 for the note plus $1,000 for the interest. And so your total liability is $51,000. And the answer is again the same for both. This answer is both notes. Both notes are going to be $51,000. By the way, I don't know if my camera is really showing that. I better check. I'm kind of getting far to the right, aren't I? Barely. Yeah, that's close enough. So, the answer to A, this is how we create a note. But then remember, really this was an account payable. We created an account payable, but then we traded it in for a note that bore interest, that bears interest. Then we got another note. We went out to the bank and borrowed some money. They said it's zero interest, but there's no such thing. The only way there's zero interest is if your mother or your father or your sister, somebody that loves you, loans you money. Love overcomes interest. But if it's an arm's length transaction, if you're borrowing money from a bank or any financial institution, they'll charge you some kind of fee. And it'll be interest. Usually it is interest, a finance fee. Then we said, well, what is the amount of interest that occurred between October 1st and December 31st? Do you remember it was 3 months? So we went ahead and accrued, remember, something has occurred. A financial transaction has occurred, but no money, no cash has moved. There's the financial transaction, but no cash has moved. Then they finally asked us, well, what do we owe at December 31st? And again, to be reported December 31st, well, we owe $50,000 plus $1,000 on both notes. There's no difference. All right, that's exercise 13.2 done. Then we're going to do 13.6, but 13.6 is really hard. I might wait and do it last. By the way, the answer to 13.6 is already posted on Moodle, and it's my answer. I think I used 2 or 3 pages to write up the answer to 13.6. It's a very long problem. So I might save that for the very end. I think I've got some easier ones that we can do in the meantime. But anyway, this will get you started on chapter 13, and really it's not chapter 13, the whole subject. We're just dealing with, again, liabilities. But more importantly, for a small business man or woman, can you see that this class, you will probably have to deal with interest if you're a small business man or woman. You'll have to deal with notes. You'll have to borrow some money. There's a very good likelihood of that. You're going to have payroll taxes. That we went over that just a minute ago. So all these things are subjects that I picked that I think relate to a small business entrepreneur. Borrowing money, paying interest, paying wages, and the withholding taxes, taxes payable on wages. And I don't think I'm going to introduce any more topics. That's everything. We're just going to do more problems from this point forward. All right, until I do that, I'll run another video once we get further along in this chapter.